Thanks for tuning into Talking Point. I'm your host, Dhiraj Shah. The case for a chat today, tailor-made to the current situation, if you will. A lot of conversation around whether the Capex push will continue or whether there will be a shift to welfare. We try and probe that. Can't not talk about IT and whether the demand pain will ease, and will Accenture's commentary, which we quite frankly read slightly differently in the morning, and the kind of reaction that we've seen in the IT stocks is different. So can Accenture's commentary bring in something that we're not quite factoring in? We'll ask our guests that. And are chemicals at a cusp of a turnaround fundamentally? Talk about all of this with Dhiraj Agarwal, Managing Director, Ambit Investment Managers, joins us right now on the show. Dhiraj, great having you as always. Thanks for taking the time out.
Thank you, Neeraj. Always nice to be on the show.
Thank you so much, Dhiraj. So, Dhiraj, we are circa new highs or thereabouts, banks leading the way recently. Where do we go from here? Are you expecting a pullback because of the valuation argument, or can the momentum sustain going into the budget and post that as the earnings season kicks in?
You'll probably have to split the answer into two parts. So the near term, I think markets are slightly in the risk zone, possibly because of valuations is number one. Number two, there are a lot of other global factors which actually might impact. Neeraj, are you there? I think I lost you.
I can hear you loud and clear, Dhiraj.
Sorry. Yeah, so there are a number of global factors at this point of time which could pose a little bit of a risk. China revival is one. There is a lot of money going into China at this point of time. There's a lot of global money going to Taiwan at the expense of India. So while the domestic money flow is still very, very powerful and strong, FPI is a little bit more circumspect on India versus few other markets, relatively speaking. And on the second side, this month particularly, and last few months in general, the supply of paper is just astonishing. I mean, just 2 days ago on one single day, 24,000 crores of block stroke QIPs got placed. That sucks out the liquidity which is going into secondary market. So there are a little bit of risks one should be wary of. And even the budget, I mean, there could be some balancing act in the budget as compared to what the market was expecting previously, which can cause a bit of a correction.
Yeah, the domestic flow is certainly very, very strong. And, you know, kind of as the point Dhiraj made, that kind of taking care of the kind of supply that is coming in. Actually, just before we get to the stock sector of the day, Dhiraj, one more follow-up. Is there a problem in this? I mean, a lot of people talk about how promoters are encashing, funds are encashing in a big way, and retail is left holding the bag. Do you see it that way? I mean, the money being put by retail, in effect, is being put by smart money managers who are mutual fund managers who've done this business for a long time.
Yeah, but you know, the smart money managers are putting money to work because they're getting inflows. And I think most of the money managers, if you talk to them one-on-one, are slightly uncomfortable with the pace of inflows coming in. So there is always a little bit of a tussle in people's mind. You're supposed to grow the business and grow the AUM. And hence, you can't really shut your doors and say, I don't want to take any more money. But people are finding it difficult now to deploy the money at the pace at which it's coming in. And remember, there is still a larger portion of the money pool coming in into either thematic funds or mid and small, and not so much large, which is actually easier to deploy at this point of time. A number of large caps are actually more reasonably valued as compared to the mid cap peers. Even last month, 34,000 crores have been flown to domestic mutual funds. The classic large cap funds got only 700 crores out of that. I mean, that is slightly funny as far as any historical comparison is concerned. So it is a little bit of a challenge.
Point well taken. Well, is it a challenge for IT stocks, or does the commentary from Accenture give a bit of an opportunity as well? The stocks are abuzz in trade. Nifty RT is the top sectoral gainer. Let me get in my colleague Rucha for a quick perspective on what is it that Accenture's reportage had, which kind of has an implication for Indian IT. Rucha, good morning.
Thank you, Neeraj. Good morning. So there are just two takes from Accenture results. Number one, it has narrowed its guidance, right? Now, this implies that there is still pressure in the discretionary spends, and this is mentioned by the management as well during the call. Now, this also implies a slower ramp up of deals, and while clients are still preferring the cost takeout deals, and this means that they are trying to reduce their cost because of the pressure on the budgets which they have right now. And this was the case which we were hearing from Indian IT companies since a few quarters, and it still continues. Next is the managed services bookings. Now, this is the segment which we look at from the angle of Indian IT services, because this is what is relevant for our Indian companies. Now, the bookings here reached highest ever mark and was up around 40% year on year. So this implies that the investors might get a ray of hope for a stable demand, if not an uptick. So Accenture was up in trade yesterday, but this was largely because of the factors which are not relevant to Indian IT companies, such as an uptick in the Japan segment and the consulting business, which is not relevant for IT companies, right? And now talking about segmental performance, there was weak segmental performance in the financial services space, which is almost the highest revenue share that Indian IT companies have, and also communications, which I think indicates weakness for companies like Tech Mahindra. And lastly, it also mentioned about generative AI, that it reported around 900 million of bookings, but I think that is still on its way. But the lowering of guidance and the pressure on discretionary spends is what is negative for Indian IT companies.
Okay, thanks a lot for that, Rucha. Dhiraj, how do you read into IT? One, that there is presumably the largest IT firm in the world, talking about doing generative AI deals, something that is still to be seen in a meaningful way from Indian IT, and the fact that discretionary spends, if anything, still continue to be, for lack of a better word, skittish.
Yeah, so I think today's IT move is not about Accenture improving the guidance at the margin in some small sub pockets, which, as Rucha very rightly pointed out, is not so relevant to India. But it's actually more of a relief that it didn't cut its guidance further, right? Because the last time when it cut its guidance, which was last quarter, it was a little bit of a shocker. I think the guidance was at a decade low, if I remember correctly, in the IT services side, and almost 8 quarters or 10 quarters low at the overall side. So no further cut is a relief which the market is celebrating. Second, just to explain the price move up today, and then we'll come to slightly more medium-term thinking on IT. It has become a very headline-driven market of late. So a 500 crore order inflow for a capital goods company where the existing order book is already maybe 90,000 crore moves the prices 5%. I mean, it's not even 5% of the order book incremental inflow, right? But it just moves 5 or 7%. So stock prices are reacting very violently to daily headlines. It has been happening for the last 2 years. It's been happening a lot more in the last 5 months. And June has been absolutely crazy in terms of reaction to headlines. So that possibly explains the short-term price movement. Medium term, I think it's just a relief that Accenture did not further cut their guidance. But more importantly, from a medium-term point of view, my read is US economy is not as weak as what we all want it to be. It's not as weak. It's not weak at all, as economists have been forecasting, which is pretty reflected in the fact that Fed has been reluctant to cut rates. But looks like we might be heading a little closer to 1 or 2 rate cuts now. I mean, either September cycle, surely November cycle. So if that visibility becomes more concrete, and when the US is a strangely capitalist country, even if there's a fear of a slowdown, people cut back on discretionary spend. So 1 or 2 rate cuts, and then people will get back to normal, saying, now it's done, rate cuts are done, fears of slowdown or recession will go away. Maybe the economy will survive, the economy will start growing again, and the spending can come back. So that is the expectation, which is more important from an IT point of view, and not just the Accenture numbers and Accenture's 8% move last night.
Got it. So Dhiraj, just to place it on record, for somebody who is looking for themes to invest in an expensive market, Nifty IT still trades at a premium to the Nifty as well, right? Is it better and more prudent to wait for an uptick in discretionary demand and buy these stocks 5% more expensive? Or is it better to preempt this, maybe not now, but even 2 quarters out? Is it better to preempt it, or is it better to wait for the proof of the uptick in discretionary demand?
You have to act, and unfortunately, you have to act in a sector which is so priced to perfection. You have to act a little bit ahead of the actual event taking place. Otherwise, there is not much left on the table, right? So, as you rightly said, IT valuations are down as compared to what it was 2 years ago. But it's not down and out. It's not. You certainly can't call it very, very cheap or distress or below mean, right? And hence, even if the uptick happens, how much the upside will be? And if you actually wait for the uptick to happen, you would have actually missed most of the moves. So unfortunately, this has become the trend, or this has become the style right now. You have no choice but to preempt it a little, especially in perfectly priced sectors where the total upside may be just 15 or 20%. So if you miss 12 out of that, there's not much left.
Got it. I have one final question on this, Dhiraj. I was doing a conversation with Persistent's Sandeep Kalra and Sanjay Jalona, the ex-CEO of LTI Mindtree, right? And we're talking about the impact of AI on IT. And I think my derivation of that conversation was that some of the nimble, smaller companies might have a head start in adapting and doing more IT, AI work as opposed to using AI for their work. And because large caps or larger companies have a bit of a legacy business as well, might not be as nimble footed. So therefore, if you want to play AI in Indian IT context, the smaller firms might stand a better chance. Is there a clear distinction between size and the ability to adapt to AI in Indian IT?
See, in general, even in the last 10 years, smaller companies have been faster to adapt to newer evolving segments, right? So whether it is ER&D, whether it's cloud computing, specific sectors which are doing well, design work, and now probably AI. And this has been a trend even in the last few years that some of the smaller mid-sized companies' growth rates actually double that of the large cap peers. So, I mean, you took the example of Persistent, for example, and LTI. Both these companies have grown at almost double the pace, or slightly higher than the large cap peers. So it's been proven not just in the AI context, but everything new and every smaller area which is evolving in the Indian space. And this is actually true globally. I mean, the larger US companies solved this issue by a very aggressive acquisition. So I've lost count of how many acquisitions Microsoft would have done in the last 7-8 years. Right? It just keeps on gobbling new companies, which is building a new tool or a new vertical or a new product or a new innovative line, and just folds it in. Indian companies, even if few of them are acquisitive, they are mostly to acquire revenue lines rather than a new skill set or a new innovative vertical. So yeah, I mean, you're right. Smaller companies do adapt faster and grow faster because of that.
Let's talk about some of the other things as well. Dhiraj, a word on banking. The last few days, private banks have come to the fore, presumably on account of FI flows. At least it coincides beautifully, and usually we've seen that pattern. But without predicting into what could happen to flows, and feel free to do that if you have a thought there, but what to do with private banks currently?
I think the valuations are all pretty attractive at this point. And again, like IT, as we discussed, valuations are attractive, but it doesn't mean that the upsides are large, right? So it's not like, I mean, markets have become very used to very large upsides because of what's been happening in a particular part of the market, mid and small infra and Capex related companies. So if you forget that and put that aside for the time being, private banks valuations have consolidated a lot in the last 3 years. They're not very cheap, but they're not expensive either. So relatively speaking, I think it's a better place to be from an asset allocation perspective, whether they're private flows or mutual fund flows. Hopefully, large cap mutual funds also get some inflows now. But yeah, I mean, on a relative, if not all, at least a few private banks are looking fairly interesting now at these prices.
Okay, but it's an important line that he makes. Valuations are attractive doesn't mean upsides are large. So that's the first thing. Dhiraj, the other aspect is this whole conversation that's crept in, that will the government become a bit more populist, not as much, but a bit more populist. Therefore, do you move to and some welfare schemes, and therefore did you move your portfolio a little bit to the staples and leave a little bit out of Capex, with the belief that fiscal deficit will be adhered to because it's an announced goal. Now, how do you think about this troika?
So there are two independent questions according to me. I mean, it may not be linked. So Capex related companies and FMCG companies and the budget implications. So uh, first, to start with macro, could there be some amount of balancing act after the election verdict and the fact that it's a coalition government? Possibly. Will there be a large needle swing? I honestly doubt. I mean, this government is they act with conviction on what they believe in. The formation of the current cabinet is actually a reflection of the fact that they are giving market a signal that it's business as usual, is continuity. There will be some tinkering here and there, but don't expect a large needle shift on their entire focus on what they believe is that if you do capex, build infrastructure, create industries, jobs will come, and rural economy and the lower urban class economy will automatically revive. So some shift maybe, a large shift unlikely. Now coming specifically to the capex stocks, they're doing well. They'll continue to do well. I think that thrust is not going away. I worry a little bit about valuations. In fact, Neeraj, very interesting conversation I had with somebody recently. I was telling them that you can basically divide the investment professionals in the market by age group. Many like us who started their career pre-2000, and then many probably who started after 2010. And the pre-2000 people are all worried slightly on the valuations in that space. And the post 2010 have seen Asian Paints go up to 120 times trailing multiple. They've seen DMart trading at 150 times. They find 80 times okay. I mean, not that expensive or cheap. So it's a nice, it's a challenging conundrum. So maybe today's investors are largely belonging to the new era and they don't really care. But I worry a little bit about valuations on the capex company side. There should be some consolidation at the minimum.
What about people like me who started between 2000 and 2010?
So between 2000 and 2010, you are in a sweet spot. There are very few people like that actually, because you've actually seen the cyclicals boom as well. Right? People like you are finding it relatively easier to believe that cyclicals can also have a 5-7 golden year period. People who started their careers after 2010, and they've seen cyclicals only crash because they came in, they studied what happened in GFC, they pulled up the price chart, they saw all the cyclicals down 60 to 95%. And they said, ye to chhune ka hi nahi hai. Never go there. Never go there. They are not able to understand why ABB can trade at 75 times or 80 times. How can BHEL go nearly to the previous peak and on paper looks like a 300 times TD. They're just not able to wrap their head around because they've not seen the whole cycle where the order book comes first, business execution follows later, and in the second or third year of execution, actually when the margins come. So you have seen that cycle, so you can at least understand and fathom it to some extent. So, but I've done a casual scan, and 2000 to 2010, there are very few people. Either it's pre-2000 or post-2008 or post-2009. I think perhaps overhired pre-2000 and maybe went slow on hiring in 2000 to 2010 decade. And then rehired again after 2009-10 when the GFC settled.
Got it.
So both the buckets are confused. The first bucket is not able to wrap their head around the valuation. The second bucket just can't understand what's happening to cyclicals and industrials.
Okay, well noted. Let me make the best of both worlds then, because since I'm wedged right in between. I have one final question on this conversation, Dhiraj, and it's fascinating thus far. I wish we can have many more of such. But I have one final conversation, and that's on chemicals. Because in all fairness, you guys had a really good hold in that super rally that happened in chemical stocks until 2021, right? A hibernation for the last 2.5 years. Just starting to turn. I've seen a couple of conference notes from your peer brokerages speak about the commentary within chemical names. How are you guys thinking about this?
So we've been thinking for the last 6 or 9 months that it's very close to a bottoming cycle now, because we have seen the surplus capacity getting absorbed, demand supply situation which had gone into an oversupply into a number of products starting to get corrected. And I mean, as I said, it's slightly difficult to time. So many of our investment vehicles actually have been building chemical positions for the last 6 or 9 months. So tested some patience for a while, but looks like finally the inflection point is coming through, where there is a revival of growth, there's a revival of pricing, and hence the margins for the chemical sector. So we are structurally positive on the space at this point. I think that 2.5 year of consolidation has absorbed the surplus supply, and the demand supply situation is getting balanced again. And there are some pockets of signs of demand revival also in many of the subsegments. I mean, it's a complex multiple product segment, very much like pharmaceuticals. Obviously, there will be nuances within, but in general, chemical space is looking good at this point.
Okay, so Dhiraj, in some sense, you are saying that, and okay, what I want to understand is, because it's a wide bucket, almost everybody says it's not a homogeneous sector. Are there subsets within where you guys are more constructive on relative to the other subsets in specialty chemicals?
I mean, I always struggle to remember names of chemicals and drugs. So,
but spec chem would stand a better chance versus commodity chemicals, you think?
yes, spec and even agrochem is showing signs of good demand supply balance.
Ah, you're saying that. Okay, agro too, because it's been a really painful period for them in the recent past. Okay, great. Dhiraj, such a pleasure talking to you today. Thank you so much. And like I said, I wish we can have many more of such conversations, maybe the next time in person.
Surely, definitely. I would love to come over to your studios next time.
Great. Look forward to that. Thanks so much for joining in today.
Thank you. Bye-bye.
All right. That's the view from Ambit Investment Managers on some of the key aspects that are the talking points of today's trade. So bear that in mind. Thanks so much for tuning into this edition of The Talking Point.